everyone. We're really happy to be here with you today for our webinar on tax issues for cloud services providers, a no surprises approach. My name is Diane and I'll be your moderator today. We've got some great speakers lined up for you here and we're really excited to get going. I've got a couple housekeeping items to walk us through before we get started. So on your webinar pane, we have a Q&A feature. To activate that, just click on the orange arrow and expand the pane, type in your questions throughout the webinar as they come up, and then we'll do everything we can to get to your questions at the end. All right, then take a look at your webinar screen for the best audio quality. If you're on the telephone, just click telephone or mic and speakers. All phone lines are muted for quality assurance for our participants. All right, so if you're logged on today to get California CE, there's a few things that you need to do. Be logged on to your computer with your own unique URL. Also, be logged into our software for at least 50 consecutive minutes within the time frame of the webinar. And then throughout the webinar, we'll have polling questions, at least 5. Just make sure that you're responding to 75% of those questions. And then at the end, you'll fill out a survey, and that's what you need to get California CE today. All right, so I'll review the learning objectives with you. So today, participants will review an effective tax provision process structure, describe the company's international structure to anticipate geographic expansion, and evaluate the company's sales use tax exposure and resolution strategies as it applies to the taxation of the cloud. All right, without further ado, I'd like to introduce our first speaker, David Sordello, CPA and partner in charge of our corporate tax at Armanino. David has more than 20 years of public accounting experience, including 15 years at the Big Four firm, where he served many of that firm's prominent semiconductor, software, and internet company clients. David specializes in compliance and consulting for complex tax and business issues of venture capital-funded private businesses, organizations on the IPO track, as well as publicly traded companies in the technology space. He has experience assisting clients with accounting for income taxes, FAS 109, FIN 48, mergers and acquisitions, R&D tax credits, tax audits, and sales and local taxation. David, welcome. All right. Thank you. So for our next speaker, we have John Davies, and John leads the international tax practice at Armanino. He spent 13 years of his 20-year career in accounting at one of the Big Four firms here in Silicon Valley. He specializes in cross-border transactions, transfer pricing, international tax structuring, mergers and acquisition integration, and global earnings and mobility strategies. John works with companies across the globe. He has extensive experience in technology industry, including internet, semiconductor, computer hardware, and cloud services companies. John, pleasure to have you here with us today as well.
Thank you, Diane.
And for our final speaker is Malcolm Ellerby. Malcolm is CPA and tax partner at Armanino. He has 25 years of experience in multi-state tax and sales tax and use, including 15 years with a Big Four firm in Silicon Valley. I think there's a commonality going on here. His primary focus is assisting high-growth software as a service companies and other cloud service providers in identifying, qualifying, and resolving potential sales use tax liabilities prior to an S-1 filing or other liquidity event. Malcolm's technology client base, although centered in Silicon Valley, extends to technology centers nationwide. Malcolm's primary focus is assisting software and other cloud services providers in evaluating multi-state sales use tax application to their business models. Malcolm, welcome.
Thanks, Diane.
All right, so then I will turn the agenda over to you, Malcolm, to review with our participants.
Thank you again, Diane. We work with a lot of cloud companies and CFOs in the Valley and host a roundtable for Cloud CFOs, and the issues that come up at those roundtables, and these are usually inflection point companies that are approaching some sort of liquidity event, and their revenue's doubling every year, and they're hiring and expanding across the country and internationally. And the issues that they discuss frequently will center around operating issues like where to locate your servers and data privacy and things like that. But it seems like half of the discussion also centers around compliance issues like, things as you approach an S1 filing, for instance, getting ready for SOX and graduating from QuickBooks to a more sophisticated or a larger ERP, and then tax issues. Surprisingly, has been, a third of the discussion at the 3 or 4 roundtables we've had. So these are the things, and usually the CFOs talk about the tax issues from a perspective of trying to avoid surprises. And a lot of them have war stories about, just before the S1's filed, there are some tax liabilities, and the financial statement auditors want to put a big accrual on the books, and there's a big rush to try to identify and clean those up. Or the board is asking, I'm on the board of several other companies, and we have an IP structure there, and they ask the CFO, have you looked at that? Does that make sense for us? And then, of course, just trying to get the tax provision together, the structure and process around that to prepare for being a public company. So these are the things that we keep hearing they don't want to be surprised about. And today we're going to review 3 of those areas. And the first one is around the tax provision and its structure and process and preparation and uncertain tax positions. Section 382 is another big hot button at our roundtables. R&D credits, stock-based compensation, and its complexities. The second area we'll discuss, and David Sordello will address the tax provision section, and John Davies will address the issues related to international expansion, location of the servers, and how that's relevant from a tax perspective. I'd mentioned that from an operating perspective, and like so many of those issues, they have a tie into tax, IP planning, proper structuring, how to hire people, whether they're employees or contractors, things like that, VAT and withholding taxes, and transfer pricing. And then finally, I'll address the sales use taxes, and that's one of the issues that seems to come up, at the last minute before an S1 filing, or if the company is going to be purchased. An M&A team, their due diligence people will parachute in and want to escrow, $2 million because the company hasn't been collecting tax. So I'll address that rapidly evolving area.
Malcolm, they're not software companies, they're service companies.
Service companies, yes. Services.
There's no sales tax.
No sales tax, that's right. That's right.
Okay. So it looks like we have our first polling question, and that is, which statement best describes your company's anticipated business path over the next 24 months? A, IPO filing in S1, sale of the company, planning to acquire another company, none of the above, or you're just not sure? All right, we'll give you just a minute or so to enter in those answers. Again, the question is, which statement best describes your company's anticipated business path over the next 24 months? Great. Okay, so we'll just give you a few more seconds to enter in your answers, and then we'll turn it over to Malcolm to comment on it. All right, so we'll close the polls in 5, 4, 3, 2, 1. Malcolm?
Okay, so 18% responded an IPO filing, S1, 14% a sale of a company, 9% planning to acquire another company, and D, none of the above, is 36%, and 23% are not sure. So that makes sense, and so it looks like over a third of the companies do anticipate a liquidity event, but obviously these things are subject to change with fast-growing cloud services companies. So let's go ahead and get started with the technical section, and David Sordello is going to cover the tax provision and process and structure issues.
So on to most CFO's favorite topic, and that is the tax provision and being audited by financial statement auditors. And most companies that are going towards an IPO, and I'm going to focus my comments really on becoming SEC ready, regardless of what path the company is ultimately going to take, because that is basically the way that most companies want to prepare, regardless of what direction they're going to go. So for most companies, they're going from a phase where they may have had audits in the past. They may have been by a different firm than is auditing them in an IPO type situation, or even a couple years before going IPO. Usually there's a, for many SaaS companies that have lived through this, there's a multi-year audit somewhere in there where 2 or 3 years are being audited all at the same time, which is always fun. And that always, for us tax people, imposes its kind of fun of doing, multiple provisions all at the same time with new data that's different from how the company's income tax returns had been previously filed in the past. So there can be a lot of fun of going back and forth and tracing numbers and doing that. But that is an important benchmark and core to build off of as you get ready to become an SEC company. The real thing to take away, I think, from the discussion that we're having today is around the process and the readiness of doing the tax provision and all the documentation necessary to get it basically SEC ready, to get all of the filing requirements, whether that's the footnotes or all the different things that the auditors are going to want to review and look at and sign off on, prepared in a timely manner, and make sure that you avoid any kind of a lot of the back and forth nature of that process, and really come out with an outcome of being an SEC ready company to have all that process down as you move forward closer to the IPO and then beyond the IPO. So the real core of the provision is really around the data and the availability of the data and the company to produce that data to feed into a tax provision. A lot of companies, and I have a few that make money before they go public, even in the SaaS space, which I know is fairly rare. But a lot of companies in this space are losing money. Tax has never really been a high point issue. Usually their biggest tax issues are around what Malcolm's going to talk about later, which is transactional-based taxes like sales tax, because those can be real taxes in real dollars. The income tax tends to be a fairly minimal amount, maybe some state taxes, maybe some foreign taxes on cost-plus entities. But from a federal perspective, usually you're dealing with companies with net operating losses and that are losing money and continue to invest in the future. But there still is all the issues around deferred tax accounting and basically filling out the tax footnote that goes into either an audit report or an S1 filing. And if, that can be a pretty burdensome task, especially if you're starting from ground zero in order to do that. And so what's really important is for that first exercise that you go through in becoming ready to basically get that to be the building block of going forward in the future, and having it really ready to take it from your financial statement books and getting those books in order, either on a by entity basis so that all your foreign entities are booked correctly, if you have foreign entities, or dealing with all the state tax consequences and all the deferred tax rates and all those kinds of things, to basically have the books support the provision as much as possible and build it that way, and then have the provision systems in place and tie-in to basically take it through the process of the audit and documentation and into the footnote. I have about 4 or 5 companies that are going public right now, or really at the later stages of preparing to go public, and there's a constant back and forth when you're starting to deal with auditing quarters. Usually the annual audits have been done, but then you're going back and doing the quarters and pushing numbers back and forth, and having the ability to quickly turn that from the provision to the footnote to the revs of the financial statement to get it to the printer is really critical. If you don't have that process down, it can be really time-consuming, burdensome, and really slow things down. So that's really the key, is to have that process lined up from the beginning. Think about all the documentation steps that are going to be necessary to get it through the audit, and not have surprises during that process, to basically not have the data that you're going to need to put in any kind of filing, and also not to be able to get sign-off from your auditors. So some of the things I have up here are systems and tools that you utilize, whether that is Excel, whether it's a little bit stronger base of Excel where it's more tailored to a particular company's needs, what the data needs are, basically the inputs for the provision, out of an ERP system, whether that's QuickBooks or something a lot more elaborate than that, and dealing with all the uncertain tax positions, reserves against R&D credits, foreign taxes, state taxes are the most common, but there can be a variety of them, and really tying in the books to the ultimate footnote through that provision system so that things can turn around quickly and be well documented. So the other things from a surprise standpoint that can come up, the only two things I've ever seen in the tax area other than just pure messiness that I've ever seen really potentially stall an IPO, one of them was sales tax that Malcolm will talk about later. The other one was 382. And 382, for everybody out there who hopefully doesn't have to know what 382 is on a daily basis, essentially is whether or not you've had an ownership change in the past or currently that would limit your ability to use tax attributes, mainly net operating losses, but also other tax credits. And a lot of times when you're a loss company and you're doing your audit, you have a full valuation allowance on all your tax assets, nobody really pushes or cares about whether that ownership change has occurred because you're not using NOLs and usually have some vanilla statement in your audit report that a change may have occurred, but it has no impact on the financial statements. So when you go public, one of the disclosure requirements and one of the key metrics is how much cash tax that you pay in the future, and whether or not you have NOLs and the value of those NOLs and when you can use them is a critical step. So I have seen a company actually miss a window when an IPO kind of timeline kind of faded because of the market, because they were going back and forth dealing with a multitude of service providers to try to deal with this issue that came up at the last minute. So it is one to stay ahead of, to make sure as you're going through the process you know where you stand, and to probably do a study, at least a high-level one, to make sure everybody's comfortable what the answer is going to be. The second one is R&D credits, really having your credits documented to a certain extent, at least so that you can do your uncertain tax positions or FIN 48 on them, enough for the financial statement disclosures. I've had auditors, even for companies that have underclaimed credits, be worried about when they turn around and all of a sudden start making money, that they'll have credits pop out of the woodworks and that they should have booked those in the past. So kind of more of a restatement or a prior period adjustment type issue. So that's another one just to get the ducks in a row, and really all other tax attributes, whether there's some kind of credits and incentives locally, et cetera, state NOLs, just to have them into the system so they don't pop up later or become a last-minute question or issue.
All right, we'll go to our second polling question, and that is, what are common IPO surprises related to the tax provision? All right. A, sales tax liabilities. B, NOL valuation / 382, stock-based compensation accounting, or all of the above. This is a test to see if you've been listening. All right, so just remember you'll need to answer at least 75% of the polling questions to receive your California CE. And we'll give you a few more seconds to enter your answers. And just know that we will have the recording available to you and the slides. We'll be sending that to you, and they will also be available on our website.
Yeah. Diane, the one thing, and this question's good, and I'll probably give away the answer here, but because I talked about two of them, the stock-based compensation and accounting is an area that has gotten more and more complicated, especially with pre-IPO companies. There's a lot more secondary sales, later round sales of options from founders to VCs and things of that nature that has really complicated it both from a book and a tax perspective. So that's definitely something to be aware of. We're seeing more and more complexity around stock-based accounting type transactions lately. So the answer, everybody kind of got it right because it is A, B, C, and D. So nobody got it wrong.
Good job. Okay. Everyone's listening. All right, so we've got one more slide for you, David.
Oh. Dang, I thought I was done. Okay. So the real issues around getting ready for an IPO are how to handle doing all this work. Whether you hire somebody like Armanino to come in and help you either in an outsourced or co-sourced fashion, or you hire somebody in-house that can do all this work for you so the CFO doesn't get burdened with doing all this work, or somebody else in the organization. And that can be really a tricky thing as far as a pre-IPO company hiring a tax person has its pluses and minuses, and that's probably one of the most frequent questions I get asked is, should we hire or should we outsource? I favor outsourcing just because usually it pays the bills for us, but the real answer is it really depends on the company. It depends how complicated they are. It usually depends on whether they have an international tax structure that they really need somebody inside the company to own, or it's really more you're going to use an outside provider to do more of the work anyway, and who can you get? The things to consider in addition to just the compliance aspects that I've kind of talked about really are, what's your story for the future? What is your effective rate going to be? If you come out and you go public with zero tax because you have NOLs and full valuation allowances for the most part, the question that's going to get asked and the thing that you should be thinking about really is, what's my long-term rate going to be? Am I going to be a 40% taxpayer because I'm mainly a domestic company, or am I going to be a 10, 15, 20% taxpayer because I'm capitalizing on all the different R&D credits, international tax planning opportunities, and other things? And so really having that story down when you go public, whether or not you've done an IP structure or anything yet, this is my long-term rate, and thinking about that and modeling things out, as John will talk about a little bit later. The other things are cash taxes, and when do we expect to start actually paying cash taxes? That can be much different than what your tax expense will be, because you can obviously start having book income that would have you release valuation allowances earlier than you'd run out of net operating losses, and you could be in a situation where you really don't have a lot of cash taxes, but you have tax expense. So that's another good thing to have a handle on. And then the last one, and it's kind of funny because one of the companies that's filing in the next short period of time, they actually already did their first initial filing, and they're going to be going public on, I believe, this filing that we're doing right now for the next quarter. They finally asked me a question I've been asking whether they needed yesterday in preparation for a board meeting we had today, and that is, what is my pro forma rate and what is my pro forma tax expense? Luckily, our model is set up wonderfully to be able to do this with a flick of the button. But in any event, it is something to think about. The other thing to think about is a lot of companies have started moving towards a deviant of the normal pro forma model, which usually takes out one-time transactions, stock options, purchase accounting type transactions, and gone more towards a cash tax pro forma model. And that may fit certain companies, and it may be beneficial for certain companies, but it also, comes with a potential cost down the road depending on how much cash taxes you pay. And also, it is still not considered the norm. So pro forma rates and tax expenses are definitely a thing to kind of think about and make sure that the model that you're doing can handle and that you have a handle on it.
So moving on to international expansion, I have to admit, after that rousing discussion over the various opportunities, risks, and compliance aspects of growing rapidly, international expansion is just going to take you to the next level. We're going to talk about a couple different things for international expansion. We're going to look at location of servers, what's an effective international operating structure, some VAT and withholding tax considerations, as well as everyone's favorite transfer pricing and how best to deal with that from a practical perspective. So moving right into the location of servers. A lot of times companies ask me, or usually it's after the fact, hey, we just put a server location with a server in a co-location in Amsterdam. Is that okay? Or the UK or Germany? Is that okay? The other thing that comes up a lot as well, we don't really know where our servers are. We use Amazon's cloud service or some of the other cloud service providers and we don't know where our servers are. Is that okay? Some of the things to think about, especially with the rapidly evolving technology around how you use the cloud and how that capacity is provided, makes this an ever-changing predicament. Many countries, especially in Asia, look to the location of server as a potential permanent establishment or taxable presence in that particular country. And so it's important to evaluate prior to, especially when servers are owned directly by the company, prior to establishing a server location in a particular country, to evaluate whether or not that country is going to tax that status of the server as a permanent establishment, or if they have rules, regulations, or cases that absolve the company of a permanent establishment in those circumstances. When you have a cloud provider situation and you don't know where the servers are, typically, and we'll talk a little bit about it when we talk about the international operating structure, typically for international transactions we prefer that those servers be located outside of the United States as opposed to within the United States. And typically with cloud service providers you can delineate or require that the servers be located outside the U.S. versus inside. But this is a constantly evolving area that should be evaluated every time a potential location is submitted for server locations. And again, wide variety of implications depending on the country involved. So what's this international operating structure? What does that mean? Well, it means a lot of things. It's a very broad category. It means everything from expanding to your next employee outside the United States to taking and moving your intellectual property, the rights, risks, and responsibilities associated with that outside the United States. And as you evaluate how best to expand, there's a lot of factors. Typically what happens when some points that you can, or requirements of an international tax structure or international operating structure, is that the have certain functions that are performed outside the U.S. and that can be R&D, that can be procurement, contract manufacturing. In the case of software or SaaS or cloud service companies, it's location of servers outside the United States. Having sales solicitation, order acceptance outside the United States, order fulfillment, post-sales services outside the United States, invoicing collection outside the United States. If you notice, there's a common theme of having things outside the United States. And so as you evaluate the potential of having an international structure, the benefits associated with it are huge. You can have an effective rate reduction of anywhere from 15 to 20% by using an international structure. But you do have to have certain functions performed outside the United States. And so if everyone's in the United States, it's going to take quite a momentous operational change to make it happen. So what does one look like? Well, here's a typical structure. I used Ireland as an example. And many large internet and cloud-based companies have chosen Ireland as a good spot because they are very friendly to international companies, as well as having a relatively low tax rate of 12.5% for trading profits. Of course, 12.5% is still very high, and so we use what's called an Irish resident, non-resident structure, where an Irish non-resident, in this case Cayman, holds the rights, risks, and responsibilities associated with the intellectual property that it licenses to the Irish operating company in exchange for a royalty. And so the effective rate in one of these structures can range anywhere from 3 to 6%. And so that's 3 to 6% as opposed to 35 to 40% in the U.S. So as you can see, it's definitely a powerful tool to effectively optimize your global effective tax rate. So what happens? Well, the Irish operating company is going to be the party that engages with the non-U.S. customers and provide that service. The servers can be located either in Ireland or elsewhere, but the service is provided off those non-U.S. servers ideally. Can also be in the U.S., but again, we try to minimize that as much as possible. the U.S. company continues to work with the U.S. customers to provide those services, as well as perform R&D and other functions on behalf of the Cayman company, for which there's a cost-sharing payment made. And by doing this, again, as we talked about, you can greatly reduce your effective tax rate on international sales. And so one of the key drivers to this is the evaluation and feasibility of a structure like this is evaluating the amount of non-U.S. sales that the company has. The more non-U.S. sales that are either envisioned or are currently occurring, the more benefit you're going to receive. Let's move on to our polling question.
Okay. So our next polling question is your company considering an offshore IP structure? The answer A, yes. B, no. C, not sure. All right, we'll give you a few seconds to get your answers in, and
just 1 or 2 more seconds on that.
how about just about 3 more seconds on that? All right, we have a couple more polling questions coming up. Just remember you need to answer at least 75% to receive your California CE today. And we will close the polls in 5, 4, 3, 2, 1. And I'll turn it over back to you, John, to comment.
Yeah, it looks like about 25% are yes, 42% are no, and 33% are not sure. Just to kind of bring that in line, about 70% of the companies in the Silicon Valley have some sort of international tax structure. So you're definitely in good company when it comes to international tax structuring. So moving on, we want to move through our next area, which is VAT and withholding tax considerations. And I'll just talk about this briefly, but it is a significant area, especially if you are providing services directly to consumers. So if you provide a service over the Internet directly to a consumer located in the European Union, that transaction is going to be subject to VAT, and you are responsible for collecting and remitting VAT on that transaction. That can range from 14 to 23%, depending on the country. If you're not currently collecting and remitting that to the appropriate, you can do it in a variety of fashions, but the European Union does have a special scheme for electronically provided commerce where you can register for all countries at once and pay that all at once. But if you are not currently doing that, that, as well as sales tax, as David mentioned previously, is one of several important areas that your financial statement auditor would be evaluating prior to an IPO or other liquidity type event. One way that companies typically address this is by using a payment processor that registers and remits VAT on their behalf. Withholding tax can also be a consideration when software is provided as a service. Countries such as Spain take a narrow view on software that is not subject to withholding tax, and so you might be encountering situations where the customer would like to withhold on the service payment that they are providing you. That can be addressed through discussions with the vendor, or excuse me, the customer, as well as evaluating the particular circumstances of each country. All right, just quickly we'll go through transfer pricing. Transfer pricing is basically the way that a transaction between related parties is compensated, and it's typically referred to as the arm's length standard. So what it means is that transactions between related parties should be equivalent to as if that same transaction occurred between unrelated parties. And that type of governance applies to all transactions that are between related parties, whether it's services, goods, licensing, lending, anytime there's a transaction between a related party. And so how do we evaluate that? What we typically do is look at documentation. And the U.S. and many, many other countries requires contemporaneous documentation to support that intercompany transaction. If you do not have transfer pricing documentation, you can have significant issues during an IRS audit. Even more importantly, it's very important that you have intercompany agreements to support these intercompany transactions. So when you have a transaction, you need an agreement. That agreement delineates a compensatory element to that service or transaction, and that must be supported by transfer pricing documentation. So what's the best way to implement a transfer pricing policy? First is to determine and evaluate, identify each one of your intercompany transactions. Second is to take those transactions and document them in a policy. Third is to ensure that you have an appropriate intercompany agreement to substantiate that transaction. And fourth is to ensure that your accounting system, as well as the finance department and other people that be involved in the transaction, understand and can implement that policy. And then fifth is to constantly monitor and update that policy and the documentation as necessary. Typically what we recommend is having a full transfer pricing study done every 3 years with updates as necessary to the comparable sets to ensure that the compensatory element is at an arm's length. And now we'll move directly on to the sales and use tax exposure and resolution strategies by our resident expert, Malcolm Ellerby.
Thanks, John. Everybody loves sales tax, right? As I referred to earlier, we host a Cloud CFO roundtable, and our objective when we started that was not to get up there and preach about tax or, frankly, to try to deliver any content. It was really to try to get some of the cloud service CFOs that are, again, what we refer to as inflection point companies whose revenue is growing rapidly and is indeed approaching either an S-1 filing or a sale of the company or some sort of liquidity event. So we don't really set an agenda for these roundtables. They come, we get started, we have some light structure, and then they run with it. And as I mentioned earlier, there are a lot of operating issues and international operating issues, especially some of which John referred to with the server locations and implications and hiring people and where to hire them and how to hire them and how to retain talent or find talent and things like that. But it did so happen that the no surprises thing was a common theme at all of the roundtables, and tax seemed to be, it's compliance issues, again, and tax was the one that got the most discussion, and I think it was because of the surprise or ugly surprise, negative surprise issue. One of the CFOs there is a prominent CFO at a big company in the Valley, and he said every time they do an acquisition, they're very acquisitive, that it costs the company between $500,000 and $1.5 million to settle the target company's sales tax liabilities, and it can take up to 18 months to clean all that up. And he said it's just a very difficult part of the process. So that's one of the surprises. Especially if you are the acquiring company, it takes a lot of your people's resources to address and clean up those issues. If you are a target, that could be an ugly surprise if as I mentioned earlier, their due diligence team parachutes in over the weekend and says, by the way, here's a conservative estimate of your exposure. We want to escrow, $1 million or $2 million related to sales and use taxes that you haven't been collecting. And sometimes the CFO or the board says, what are you talking about? We're a services company. The cloud's not taxable. So that's another surprise we heard. If you are approaching an S1, the auditors will bring you lots of surprises on the financial statements. Hopefully not too many. David had touched on some of those. I think John indirectly did because that's still part of the provision. All of these things are tied together. Everything is, from a tax perspective, as you prepare to go public, is provision-centric. Although sales tax is really not an income-based tax, so it's not really part of the provision. There's still an accrual issue, and your auditors, at some point when your company starts doing really well, and your revenue doubles every year and you hit that inflection point growth stage and approach an event, your auditors, if you haven't thought about it or haven't addressed it, will. And they may suggest an accrual, and then there's a P&L hit, and there's a big scramble to try to pull those numbers together, and it just takes a lot of time and energy that you don't have a surplus of when you're scrambling to hire people and scale and grow the company. You're trying to minimize the amount of resources you're putting into compliance issues. So.
Right. And Malcolm, in the old days, we used to just stick the $1.5 million accrual on the books and nobody cared, and maybe later you'd get to release it and it'd be income after you went public. Today, the auditors want to get that number pretty much right. I mean, there's no measurement of over versus under accrued. Both are bad. So that's why it takes so much time. You really got to nail down the number, which is something you don't want when you're trying to file an S1 or do something like that.
Yep, and within the provisions of FAST 5, which is now, I think, ASC 450 with a new code, you know, if in the cloud, if you have Nexus, and this is coming up on an upcoming slide, if you're taxable and you have Nexus in that state, I mean, it is likely that that you have an issue. So there will be some sort of accrual. It's just determining what that number needs to be and how to haircut it for different things, which we'll get to on upcoming slides. So a lot of times the first step then for the CFO, even if the CFO or the finance chief says, look, I don't have time to address this right now. I know it's an issue. We'll deal with it when we have to. And frankly, that's just the way sales tax is. However, what we're hearing is that the CFO does not want to be surprised. They at least want to know what that range is. So they'll do an analysis, say, Malcolm, look at our business model and tell me where we're taxable. And then there's a nexus discussion, you know, where you have a sufficient presence, which is usually salespeople. If you're a B2C selling to enterprise companies, you've got people in the field. And I don't really want to go into a long nexus technical discussion, but most of my B2C large cloud companies have enough presence in the field through salespeople, even if they're non-resident, to establish nexus. So at least run the numbers and get a sense for how much exposure there is. And, you know, even if you come up with a certain number, that number in the lower right hand of that Excel spreadsheet is usually a very unpleasant number if you're an inflection point company that's growing quickly and has, you know, $50 to $100 million in sales annually. But the comfort is, especially if you are B2B and you sell to a lot of enterprise customers, many of those have self-assessed tax or, you know, have direct pay permits, so that number is always not going to be the number. So, so at least know what the answer is or what the range is, even if you choose as the finance chief not to act on it. At least you know what the number is, and when the time comes, and you'll know when that is, to pull the trigger, you can address cleaning it up then. So we've got another polling question.
All right, so the polling question is, how many states tax hosted software? A, 0, B, 15, C, 5, or D, 25? All right, so I'll give you a bit to enter your answers in, and just know that we'll have a recording of this webinar available to you shortly after, at least I think 72 hours within the webinar. We'll send it off to you. Also, if you have any questions for our presenters today, go ahead and type those in. We'll get to those at the end, but we're looking forward to answering the ones that we have already in. All right, so we'll give you just a few seconds and we're going to close the polls in 5, 4, 3, 2, 1. Thank you.
Okay, so 8% responded 0, 42% 15, 42% 25, and 8% answered 5. The answer is closer to 15, and the way the question is stated is hosted software, but a lot of cloud services companies are not simply hosted software, so that's a good segue to the next section. So in the old days, you had on-premises software, and it was tape or disk or CD-ROM, and then 15 years ago, the downloaded software became a popular delivery model, and there was a big scramble as the states adapted to that, and oh well, it's not tangible media, it's downloaded. And then it was difficult to try to identify the states' positions on do they tax downloaded software. Most of that is washed out now. There are only, I think, 13 states that don't tax downloaded software. But at least back then, it was still software. It was just a question of whether it was on-premise, tangible media or download was the only variable. Now, with hosted software or remote access software, with these evolving cloud business models, you have to ask, even if it was still just hosted software, the states are at the point now where they're having that same evolution and, adapting their tax structures as they did 15 years ago with downloaded software. So I guess about 15, I would call it 15 to 18 states, including D.C., tax what I call plain old hosted software. But you really need to look at your business model. I have a lot of cloud companies that are not just hosting software. There are different service components of what they do. And in fact, a good example of that is there is a SaaS client of mine that offers a physician practices billing platform. And the customer actually is accessing my client's software to do its own billings for the insurance companies. Well, one of their customers pushed back and said this isn't taxable, and they sent them a ruling, and that ruling, actually the facts were that the service provider was using its own software to do the billings for the physician practices. The practices would send them the data, and they use their own software to perform that service, whereas with my client, their customer was using the client software to do their own billing. So the true object test is what we're seeing in states that would tax this as software. And that's another problem because a lot of companies don't understand that the states may not tax this as software. They may tax it, like Texas, as a data processing service, or Ohio as an electronic information service, or Washington as a digital automated service. So even if what you're offering is not really software, the customer's not using our software, we're providing a service, or even if it's simple storage, a state like Texas and Ohio will tax those cloud models as these other either data processing or electronic information services. So it doesn't have to be software. So usually, I got a call or an email rather, from a CFO this morning. I'd met with him and kind of done that high-level analysis a year or so ago, sent me an email this morning and said our revenue was really ramping up. We need to look at this more closely and take some action. So I said, please send me your MSA or statements of work or attached exhibits so that I can evaluate the agreement that you have with your customer and try to figure out what you're doing. So to wrap this section up, it's not just a matter of download versus tangible media. Now it's even, what does the company do? Are they even software? And if they're not, if there's some other cloud business model, could they still be taxable? So once you decide, okay, what are we going to do about this, and how are we going to, it sounds like a big project, and I don't have resources for this, and I don't have the time for this, and we've got a lot of issues, to try to fix this, and people generally do not like to deal with sales tax until they have to. So it's just the way it is because they have other priorities and even other tax priorities. So when they do get around to fixing the problem, it's like, okay, so we've got $1.5 million accrual on the books. We are about to implement a more sophisticated ERP system, and we want to start collecting tax everywhere. So can you clean this up in the next month? Because we're going to go live with our sales tax compliance software, October 1st. And it doesn't work that way. I mean, you've got to have a very deliberate process to try to clean up prior periods. And as I'd mentioned before, it is possible to go back to your customers because, if you're selling to a large enterprise Fortune 100, 500 company, they have a pretty good idea of where these services / products are taxable, and they may have already self-assessed the tax. Or you may be able to back bill them, or if they're a large enough company, they've probably already been audited by the state or have a direct pay permit or a multiple point of use certificate. And I mean, all of those things are issues that we could do a whole webinar on. But so the liability that you've estimated is not necessarily going to be out of pocket for the company, but it is a substantial undertaking to, figure out how much tax is due in each state for each customer in each jurisdiction, and then communicate with that customer and send them an XYZ letter and say, hey, do any of these apply? And then you go to the state, if the dollars are big enough, and try to limit the look-back period if the company's been around, 10 years, and a lot of the cloud companies haven't, but you can get a look-back limitation, say, for 3 or 4 years, and get a penalty waiver, which frequently is 25% of the tax. So if you have a $500,000 liability in New York or in a state where it's 25%, that's a big 6-figure penalty you can get waived by doing a voluntary disclosure or VDA. So hopefully there are only a few states where you have to do that, and you can get things cleaned up. But I think from an ops perspective, CFOs are concerned that, hey, I've got to communicate with the board or the executive committee, the E-team, that we're, number one, going to start collecting tax, and number two, we're going to go back to our customers to see if they have self-assessed or possibly even to try to back bill them. And those sorts of things it's very important to communicate effectively with your team, whether it's the sales VP or the sales execs whose customers may be affected, or again with the executive team, so that guess what, we're, as part of this S1 filing preparedness, we are going to do this to clean this up. We're going to start collecting tax instead of taking the margin hit. We're going to pass this tax on to our customers. So we need to work up FAQs for our customers and have technical memos that address why this is taxable for the inevitable questions that will come back from the customers.
Okay, and for our 5th and final polling question, does your company have an accrual on the books for potential prior period sales use tax liabilities? A, we have an accrual on the books. B, we are evaluating a sales use tax accrual. C, we have determined that an accrual is unnecessary. Or D, not sure. All right, we'll give you just a few more seconds to enter your answers, and we'll move on to getting some questions answered. So if you have any questions for our presenters, go ahead and enter them now, and we'll get to those in just a minute or two. All right, we'll close the polls in 5, 4, 3, 2, 1, and I'll turn it over to you, Malcolm.
Okay, 33% have an accrual, 17% are evaluating, 25% it's unnecessary, and 25% not sure. And that makes sense. I mean, it's all over the board and depends on where the company is in its life cycle and, lots of things if they've been stung by state or things like that.
All right, so let's look at what we've covered today. We've looked at tax provision considerations when preparing for the S1, maintaining tax attributes and tax implications to be aware of when headed for an IPO. We also addressed international tax considerations, including location of servers, structure, VAT, and transfer pricing. And then finally, with Malcolm, we just looked at the sales use tax exposure resolution strategies, what to avoid, and how to fix the problem. So we hope you've taken away some good information today. I think we have a few minutes to review some questions. Let's see, we've got one here for you, Malcolm, and that is, how close to an S1 do companies usually look at sales tax?
It's hard to say. I mean, it depends on whether, the auditors have raised the issue or if it's even on their radar. Hopefully the CFOs have at least come up with a number and know what that number is, but they don't always act on it until they have to because of the resources that it takes to address it. And similarly, David and John and me on the sales tax, we could do 2-hour discussions on each of these sections. So if you are a rapidly growing or inflection point company, feel free to ping us with an email if you'd like to discuss some of these issues. I mean, cleaning up sales tax, we could have a 2-hour conference call on, and I'm sure it's the same thing for international, or more so, international planning and the myriad provision issues.
I think on the sales tax side, it's really, as Malcolm said, don't be surprised. Know whether or not you are likely subject to sales tax and kind of at least monitor it. Whether or not you put an accrual on the books or do anything about it, you should at least know whether or not. And 3 years ago, Malcolm and I used to go out to SaaS-based companies. We'd talk about sales tax, and CFOs would almost throw us out of the room. And I think today, most people know that there's a potential sales tax liability, and it's really just keeping your eyes on the ball and making sure you plan ahead.
Great, thanks guys. And then I've got a question for John. So John, when should companies contemplate an offshore structure? What are the trigger events?
Yeah, there's a lot of good opportunities to evaluate an international structure. Typically, if you're looking to move into a new product line, if you're looking to expand internationally, also a good trigger point is the evaluation of a valuation allowance release, because due to timing of when payments need to be made associated with the offshore structure, the valuation allowance release timing can be good. Typically what we recommend is a company perform kind of a feasibility analysis to evaluate their current operating structure, what they see over the next 4 or 5 years, and then determine the most appropriate time to put in place one after evaluating what the potential benefits are.
Great. Okay. So.
And there is very common question I just saw here on sales tax. How successful are providers in obtaining self-assessment provisions and contracts to push the sales tax problem onto the customers? Is this adequate compliance? And that is just, that's very typical of sales tax. Let's just try to Band-Aid this and avoid the issue. If you put an indemnification clause in your contract, that will usually not let you off the hook. And in fact, if you go look at Amazon's website or some of the other big guys and look at their sales tax FAQs, they say, we have done this evaluation and we will be collecting tax from you. And they also include the same thing for international and VAT. So just putting an indemnification clause in your contract, when the state comes to you and says, here's your bill, you'll say, oh, but I've got this indemnification clause, and the state will say, well, good. Go ahead and cut us a check, and then it's good to know that you have contractual recourse against your customers. Good luck with that. So it's really not an easy way or an effective way to avoid the issue.
Great, thank you. Great answer. And one very quick question for you, John. How often do I need to do transfer pricing documentation?
Typically, we recommend that a company go through and do the full documentation about once every 3 years, and then evaluate on an annual basis whether or not the comparables that are used for the documentation, the other companies that are evaluated to kind of benchmark that arm's length principle, are still in line. So if you're a cost plus 5% sales and service subsidiary, it probably doesn't need to be evaluated too often, but you do need to have documentation both from the U.S. and the local jurisdiction perspectives, depending on the country.
Great. All right, John, Malcolm, and David, thank you for being with us today, and thank you everyone else for tuning in. Up on your screen is the contact information for our presenters, so if you'd like to get in contact with them, please do, and we'll be sending you the recorded presentation as well. So thanks a lot and have a great day.